Inflation is the sustained increase in the general price level of goods and services in an economy over time. When inflation occurs, the purchasing power of money decreases, as it takes more units of currency, cost more, to buy the same goods or services. The impact of inflation on the stock market can be significant and can affect various aspects of investment and market behavior. Stock valuations. Inflation can impact stock valuations. As prices rise, companies may experience higher costs of production, such as raw materials and labor. This can lead to lower profit margins, which can result in reduced stock valuations. Inflation erodes the real value of future cash flows, making them less valuable in today's dollars, which can lead to lower stock prices. Interest rates. Inflation can influence interest rates set by central banks. When inflation rises, central banks may increase interest rates to curb excessive spending and control inflation. Higher interest rates can impact the stock market by making borrowing costs more expensive for companies, which can potentially reduce their profitability and negatively affect stock prices. Additionally, higher interest rates may make fixed income investments, such as bonds, more attractive relative to stocks, potentially leading to a shift in investor preferences away from stocks. Investor sentiment. Inflation can impact investor sentiment and market psychology. If investors anticipate high or accelerating inflation, they may become more cautious and adjust their investment strategies accordingly. Fears of inflation can lead to increased market volatility as investors reassess their expectations and asset allocations. Industry performance. Inflation can affect different industries in various ways. Some industries may benefit from inflation, such as commodities or companies that can pass increased costs onto consumers. On the other hand, industries that rely heavily on borrowing or have long-term contracts with fixed prices may face challenges due to rising costs and stagnant revenues. Real assets versus financial assets. Inflation can impact the relative attractiveness of real assets, such as real estate or commodities, compared to financial assets like stocks. Real assets may act as a hedge against inflation, such as gold and silver, as their prices can rise with inflation or provide income streams that adjust for inflation. Investors may allocate more of their portfolios to real assets during periods of high inflation, potentially leading to a decreased demand for stocks. It's important to note that the relationship between inflation and the stock market is complex and influenced by various factors, including economic conditions, government policies, and investor expectations. While inflation can have short-term effects on stock prices, the long-term performance of the stock market is influenced by a wide range of factors beyond inflation alone. If the company is profitable and has a strong economical moat, the stock will perform well over the long run. Please check out more videos on our channel.